Hello, everybody. It's your boy Charles Tank Harris, founder, CEO of the Black-owned financial planning firm Wealth Our Way, where we believe wealth is not only for the wealthy. So here's the deal. I'm supposed to be on vacation today. I am actually on vacation. I'm in upstate New York doing some things that I like to do around these times, but the reality is that there's no rest for the weary, and work is always needing to be done. I'm passionate. I am purposed to bring financial literacy to not only my community from which I came, but to everyone who's seeking to just make this country a better place by equaling out the haves and the have-nots with access, making sure that everyone has the same ability. When we all bring children into this world, we want the same things for them. We want them to have opportunity. We want the tenets that this country was built upon to be true. We want everybody to have the same opportunity if they're willing to work to reach the heights of any dream that they have. Financial empowerment, economic empowerment, all encompasses that goal. So I come here every day, 12:30 during the week, to spread financial literacy, economic empowerment, monetary excellence to those of you who wish to get it. And today, it's business as usual. So it's 12:30. I welcome those of you who are here for the first time, and I welcome back those repeat offenders who like to come hear what I have to say. Today is part 3 of the series on all about life insurance. Today we are going to tackle, hey, what's going on, love? Happy NFL kickoff day to you as well. Looking forward to that. Are you ready for some football? So this is the most complex of all the life insurance policies that are available. And the reason universal life is so complex is because it offers the most options. It offers the most flexibility. When there is choice, there is always trouble. When there is choice, there's always the opportunity for corruption and collusion and all of these things. Another reason why financial literacy is so important. I said yesterday or the day before, I don't believe there is any such thing as a bad financial product. What is the case is there are bad financial marriages. Everyone needs to have an individual understanding and identity financially for themselves, whether they work with a professional, whether they do not. They need to understand what their goals, their risk tolerance, their objectives are. Once you understand that, you can better navigate the landscape of all the financial tools and products that are out there for you and not end up in something that you're telling your friends is horrible when the reality is it may not be horrible, it was just horrible for you. There are very few financial products out there that get more lawsuits raised, more unhappy customers, more bad raps than universal life insurance, and in particular, indexed universal life insurance. Ironically, I love these things, and I'll explain why. The reality is that flexibility in the right hands is great. The more flexibility we have, the better it is. Flexibility in the wrong hands can be a nightmare. Unfortunately, there are a lot of people out here, as the saying goes, caveat emptor, that's buyer beware. There are a lot of people out here who will sell you anything. And unfortunately, you guys, the clients, are most to blame. And I'll keep it funky here because I don't sell insurance anymore. So I don't care if people get mad and say, oh, I don't like what Tank is saying. It's not like you can buy from me anyway, so I'm gonna keep it real. You guys are often to blame. Chris Rock did a stand-up and he picked on insurance in his stand-up. He said insurance is for in case ish happens. I don't know if I can curse on Facebook Live, so I won't. He said insurance is for in case ish happens. So he said, if ish doesn't happen, shouldn't I get my money back? And everybody clapped and agreed because we hate paying insurance premiums and we feel like we paid for something we didn't get. Understand this, like I said yesterday, we don't buy auto insurance hoping to crash our car. We don't buy homeowners insurance hoping to burn our house down. We don't buy life insurance hoping to die. We are not actually paying for the payout when we buy insurance. We're paying for the peace of mind that comes from knowing we won't get burnt if the worst thing happens. If we keep that in mind and understand what we're paying for, we would love insurance. But unfortunately, when Chris Rock is joking for laughs and claps, we focus on the wrong thing. We focus on the payout. We're not buying a payout. Well, it's with those types of thoughts in mind that the insurance industry responds to what the customers are asking for. So and I really believe Chris Rock deserves some credit for this. I saw this policy get invented, this new policy called refundable term insurance, right after his stand-up. Hey, Andrea. Right after his stand-up, it was a raise in refundable term insurance. I am here to tell you, I do not like refundable term insurance. It's not the best product for people. You have to have a very unique set of circumstances for refundable term insurance to make sense. Refundable term insurance, the reason I'm talking about that today, I'm sweating a little bit, excuse me. Around my nose. You can't see the sweat. Hi guys. So, and I'm in an air-conditioned hotel room. That just goes to show you I sweat everywhere. So, refundable term insurance is a version of, what's up, Big Joe? Is a version of universal life insurance. What it basically does is it charges you too much money for term insurance every year. The insurance company invests the overage that you are paying. It makes money off the overage. Then at the end of the term, it gives you back everything you paid. You think you made out because you had insurance for 20 years and you got your check back that you paid, but the insurance company made out. They took your premiums, they invested it, they made a boatload of money, and if you would have passed away in that 20 years, which they knew you weren't going to actuarially, then you would have gotten a bigger check. The reality is that you've heard people say in the past probably, buy term, invest the difference. That's a great idea if people actually invested the difference. I'm here to tell you as an advisor for 22 years, very few people do what they say they're going to do unless they have somebody on their neck every day to make sure they do it. And then people like me get tired of being on your neck. You know, and my man Joe, I always pick on Joe because I love him and that's my guy. It's my old head, not by much. I ain't aging Joe. But Joe knows as a trainer, you can work somebody out all day. You send them home. If they won't eat that Big Mac and those fries, what can you do? You know, you work them out the next day, no change is happening. So it's the same thing with financial planning. When you look at universal life insurance, the reason it exists is because you had term insurance and you had whole life insurance for so long. And term was affordable, but people didn't like paying into it, knowing what we talked about 2 days ago, that it most likely wasn't going to pay out or be around when the person died. Whole life, people love the concept of having cash value, having a policy that would be there when they died, but they didn't want to pay $500, $600, $1,000 a month for it. Universal life was the midpoint. What I tell people is think about it this way. I like to give analogies that get off the financial subject so it's easier for us to understand. People want to buy a car. Buying a car over a 60-month period, now we've stretched car notes out to 84 months, but it used to be a 5-year car note, 60 months. Dividing a $40,000 car by 60, what's up, Newt? A $40,000 car by 60 months and adding the interest, payments to be $750, $800 a month, people couldn't afford it. So what did they come out with? Leasing cars. So now you're only paying for 2 or 3 years of the value of the car over a shorter period of time. It's cheaper. I want you to think of universal life as being in between leasing and buying. What if I told you you can buy the car and you can either pay the lease payment, which is very, very cheap, it's the lowest payment. You can pay slightly more than the lease payment and never have to worry about getting asked for extra money again. Or you can pay almost a car payment and still be leasing the car. It's very weird and confusing to people. That's what universal life does. Universal life has several premium options that provide you with flexibility. It has the minimum premium. This is the premium that based on today's expenses when you buy the policy, so long as you pay that minimum premium, your policy will stay in effect. Then it has what's called the target premium. The target premium is higher than the minimum premium, and it tells you that the target premium is what we expect you to pay, even if the expenses in the policies does go up, which it will go up, and I'll explain why it will go up. As long as you've been paying the target, you won't be asked for extra money ever. And then you have the maximum premium, which is the most you can put into the policy without turning it from a tax-free policy into a taxable policy. When you put too much money into a cash value life insurance policy, it loses its tax-free status. It changes from being an insurance policy to what is called a modified endowment contract. The insurance industry loves acronyms, so we very seldom ever use the whole words in the insurance industry. Modified endowment contract is often called MEC, M-E-C. So you'll hear somebody say, you can't put that much money into the policy, you'll make it MEC. That means you'll lose your tax-free status and it will become a taxable event. And that taxable event is only for when you're pulling the cash value out of the policy. So as I talked about yesterday with Whole Life, Whole Life is a great tool for wealthy people and people who avoid taxes. I do it for my children, my high-end clients do it. We put money in whole life policies so that we can grow the cash value and take the money out later and pay no taxes. If we put too much cash in, the government has a ratio of how much insurance should be bought for every dollar that goes in. If we put too many dollars in and don't raise up the insurance, we go over that equation and we turn the policy into a MEC. And when we take our cash out, the government will tax us. So professionals, make sure you don't put too much in. So let's talk about those three levels of premium: minimum, target, MEC, maximum premium. When you buy term insurance, and I got to go back to the lesson from 2 days ago. When you buy term insurance, it's pure life insurance. An insurance company has figured out what the cost of insuring your life is. They've added a little bit of padding for their company expenses, and that is what your premium is. When you pay the minimum premium inside of a universal policy, you are paying that term cost plus a small buffer. Very similar to a whole life policy. Some of it's going to pay the cost of the insurance, some of it's going to a savings account. Unlike yesterday when we talked about whole life, the way they credit the savings account in a whole life policy is with the dividend that the company declares. In universal life, it's not credited by the dividend. It's credited by a stated interest rate. The insurance company picks the rate. They will tell you two separate rates. They will tell you the guaranteed rate, minimum, that they promise they have to give you, and then they'll tell you the current rate. The current rate is always a little higher than the guaranteed rate. But by guaranteed rate, always pay attention to your guarantees. That's the one they have to give you. The current rate changes all the time based on interest rates. So I'm going to give you a quick history lesson on life insurance policies, why so many people are leery when they talk to an insurance professional if they don't have the right knowledge. When you see a life insurance illustration, that means someone is handing you a piece of paper stating two different things: what they guarantee will happen with this policy in the worst case scenario, and what's happening currently. By law, they are always required to show you what's the worst case scenario, and then they're allowed to hypothetically illustrate, based on what is currently happening, what they expect the policy to do. This is for cash value policies. So when interest rates were very, very high in the 1980s, and I'm born in 1970, so I was a teenager in the 80s, interest rates were ridiculous. They were double digit. 12%. When you put money in a bank account, you get 12%. Even when I became a financial professional at the end of the 90s, in 1998, the money market rate at my firm was 4.25%. That's unheard of now. You're getting like nothing, or 5 basis points. You're getting very, very little. Back then it was higher. So imagine you bought a life insurance policy in 1985. The agent comes in, he shows you this illustration. Because interest rates are 15%, he's showing you that your cash value on your policy is anticipated to grow at 15% a year, 12% a year, 10% a year, very high numbers. Remember when we talked last week about the stock market averages 10% a year. So if you have 10% in something that goes up and down, or 12% with a solid financial company like a New York Life, you're going to think this is safer and you're going to go with it. Well, what happened from 1985 to today, interest rates have done this. They've gone down to damn near zero. We live in an interest rate environment where you can get a mortgage now for 3%, 2.75%. You can't get any money on your bank account. Well, guess what? I told you yesterday, people pay whole life insurance for 30, 40, 50, 60 years until they die. So if you bought a whole life insurance policy in 1980 and it was projected to be growing at 10, 12, 15%, it's not doing that right now. The person didn't lie to you. They hypothetically illustrated what was happening at that moment in time with the thought that it would keep going that way, which is why the law always tells you past performance cannot be a guarantee of future anticipated returns because things change. So here's the flip side of that. I feel sorry and bad for anybody who bought things in the 80s and had these high hopes and dreams that interest rates would stay high, and they did not. But here's the good news for us today. Interest rates are as low as they can possibly get pretty much. They can't go negative, right? They can go to zero. So when you see an illustration from an insurance company today, the illustration is so conservative and low. In the most cases, I'll talk about the people who are BSing and who are trying to trick you. But for the most part, the illustrations are so low, what can happen? The rates can stay the same, or they can start to go back up one day. So you are almost looking at the worst case scenario with what you see today. You can have a lot more comfort that when you see a life insurance illustration today, that's really what's going to happen in the illustration. No guarantee it will, but you can see that it's going to happen. When we're talking about the universal life policy, the reason people get confused is the cost to insure your life for an insurance company goes up every year. Every year you get older is every year you're closer to dying. So the insurance company knows sooner or later, if we still hold insurance paper on this person, they're going to die, which means the cost of insuring you is going up every year. Whole life locks in the cost of insuring you. That's why it costs so much early on. They lock in this rate and they keep it forever. Term insurance and universal life, they don't lock in the rate. Every year they're anticipating this cost to be higher and higher. So now we go back to this premium that you're paying. Well, the premium that you're being quoted today isn't the cost of insuring you 20 years from now, 30 years from now. That cost is much, much higher. How does the insurance company take care of that? They take care of it from that cash value bucket. When I talked to you about whole life yesterday, I told you that the cash value is for you to borrow against later on in life. You can borrow against it and not negatively affect your policy. In universal life insurance, that cash value is more there to support the increasing cost of insurance when you get older. I'll repeat that. That cash value inside of your universal life policy is a bucket of cash that you shouldn't touch, that when you get older and the cost of your insurance has quintupled, meaning it got 5 times more expensive, you can keep paying the same premium you paid 30 years ago because the increase is being taken by the insurance company from that cash reserve. Do you have the legal right to take your cash value? Yes, you do. It's your cash value. If you do, can you expect a letter from the insurance company saying, oh, your insurance premium was $205 a month when you were 30, but now that you're 71, it's $900 a month. That extra $700, we were taking it from your cash value, but you just took it out to go buy a timeshare in Minneapolis. So we need you to stroke us this check, homie. If you do that, now you're in retirement, you're on a fixed income, and you get this letter. I've had many clients that have come to me as a planner who got those letters, and they think they've been tricked. And I show them what they signed up for. No, you didn't get tricked. You chose to pay the minimum payment every month, which you had a right to do. You grew a cash value, which would have covered it if you left it alone. But 2 years ago, you took some cash value out to give your granddaughter money to help her with college. Now you don't have enough reserve to pay this increasing cost. But it was right there in the contract on page 37 on the 14th line down in the microscopic paint that this could happen. So nobody lied to you on paper. The person who went and sold you the policy, they may have lied to you. I wasn't there. They may have fabricated the truth. And this is why people don't like insurance salesmen or financial product salesmen, because they're more knowledgeable than you sitting across the table, which is why you should have a financial bodyguard, like a planner. When you go to these people who sell the products and they sit there and they tell you, oh, whole life is cool, but it costs too much money, I can sell you something that's exactly like whole life, but is a third the cost. I had my man Joe answer a question for me yesterday about if I had a whole life policy that I'm going to pay for 60 years, but I also have a choice of a whole life policy that I'm only going to pay for 10 years, which one should cost more? And Joe, of course, because he went to the great Temple University, correctly answered that the 10-year one should cost more. Come on, people. We all have brains. We all have common sense. I'm your financial genius and guru. If you have a financial question, yes, hit your boy up. But you don't need to hit me up on certain things. You know common sense. You know that if there's a whole life product and it costs $600 a month for a reason, and somebody tell you they got the exact same thing, but you can pay $200 a month for it, you got to know it's not the exact same thing. There's a reason 200 and 600 have different prices. So when people come into your living room telling you to buy this universal life product because it's the same thing as whole life, hey, this has cash value, this has cash value, they're telling you part of the truth. My favorite television show, even though I don't watch TV anymore, I do watch streaming. My favorite TV show is Law and Order. I love Law and Order. I think I should have been a lawyer. I love the part about the truth, the whole truth, and nothing but the truth. Because all three of those elements are needed for you to not be being lied to. And insurance salesmen often just tell you the truth. They don't tell you the whole truth, and they don't tell you nothing but the truth, but they'll tell you the truth. And then they'll stand by that when you're arguing with them. So universal life lends itself to a lot of unhappy customers because prices go up in universal life. But as I even told you 2 days ago, I put universal life in the permanent category, not the temporary category with term insurance. So how can something be permanent, but there be a chance you can't have it when you're older because you can't afford it anymore? That price went up because you didn't fund it properly. If you ever buy a universal life product, this is a word of wisdom from your guy, always budget buying the policy that you can afford the target premium for. Knowing that if you run across a hard time or you have an opportunity to spend money somewhere else and you need some money to save, know you have the flexibility to drop down to the minimum for a little while, but expect and plan to go back to the target. If you fund it at target, you will be fine. If you fund it at minimum, you will run into a problem. Let's shift from straight universal life to a product called indexed universal life insurance. So I told you universal life is a policy where the insurance company tells you a stated rate of interest will be credited to your cash value. That's cool. That's pretty easy to understand. Insurance companies also have the ability to tell you, we're going to credit your account, but not by a stated rate. We're going to credit your account. What's up, Big Joe? I appreciate you, baby. We're going to credit your account based on some index that we're using. So the most common one is the S&P 500 index. The insurance company, they put money into investments and they buy, I'm going to confuse the hell out of you and I'm sorry, but y'all want to learn this topic. This is just the best way for me to explain it. They buy options, stock options on the New York Stock Exchange or the S&P 500 or the Dow Jones or the NASDAQ, whatever index they buy them on. The options allow them to make money when the stock market goes up, but it allows them not to lose money when the stock market goes down. The only thing they lose when the market goes down is the cost of the option. So they will buy these options, they will watch the market. When the market goes up, they credit your policy with the percent of the uptick of the market that they promised they would credit it with. So they don't always give you 100%. Sometimes they'll give you 80% of the upside. And they always cap what your upside is. They may cap it at 10%, 12%. The market has had historical years where it's went up 40 some percent. You're not getting the 40%. You're going to get whatever the cap is in the policy, and they spell it all out for you. The reason people like index universal life policies, and I am one of those people, the reason I like it is because I can get a better crediting rate than this 2%, 3% you're telling me, but I can't get a negative return. Because just the same way the insurance company can't lose money when the market goes down, they won't credit you negatively. What they will do though, is they will pass on the cost of the options that they bought to you in the form of expenses. So you may have a built-in 1.5 or 2% expense in your IUL. Index Universal Life is another acronym, IUL. So when the market does negative 20%, your cash value won't go down 20%. It'll get credited with a big fat zero. However, zero won't be the end effect for your year. The expenses will also come out. So you will go down 2% or whatever the expenses were. I personally like that. I like having the ability for a higher upside and knowing what my downside is for that segment of my portfolio. Because you, as the insured, are not actually investing in anything, you're buying insurance, this product is not considered an investment, even though it's tied to a stock market. Because the insurance company is investing, you're not. Remember, I told you last week the difference between investments and savings. Investments can lose money. Savings cannot. Savings can always, at the worst, just not gain money. You can stay at zero. Investments fluctuate. Higher upside, potential for downside. Savings, lower upside, but no potential for downside. An IUL policy is still considered to not be an investment, and you should look at it as an alternative to savings, not as an alternative to investments. So this is probably the most hairy topic that I'm ever going to get into with you guys, but it's 26 minutes in. I will probably come back and revisit IUL as its own separate category on another day. But if you guys have any questions on the topic, by all means, inbox me. Go to wealthourway.com. I encourage all of you guys to go to wealthourway.com and sign up for our newsletters. Sign up under the contact us so you can get on our mailing list. It's always great information and it's 100% free. So I appreciate you guys. I will be back tomorrow on Friday to talk about juvenile life insurance policies, why I think they're a good idea, whether you use whole life, limited pay whole life, or universal index policies. And I'll be here to answer any questions on life insurance before we move into next week's topic. So thanks for coming. Remember, wealth is not only for the wealthy. You too can be a millionaire. I will help you get there. Keep listening. Thank you guys. Have a great day.